Okay, 12:01. So we're going to get started. I'm just going to do a quick welcome. We are so happy that that so many people signed up and that this has been successful. We've already got the next 5 scheduled for the rest of the year. So any input that you guys can give us would be totally welcome on topics. We've got some great topics that if we've got time at the end, I can share with you guys. Um, so we've got a wide variety of folks on the webinar today, which is awesome. So it's not all Lilyfield clients today, and we've got a lot of our bookkeepers are on here as well, getting a refresher on the balance sheet, but also seeing what you guys are asking, what kind of questions you guys are having, so they can help you out as well. And we've also got folks that are not Lilyfield clients. So we're going to try and tailor some of this webinar towards you as well. And then last, we've got some nonprofits on the call. And for people in the for-profit world, you don't know this, but nonprofits have to call their balance sheet something else. They call that the statement of financial position. So we'll try to work in a little bit of that as well, just for our nonprofit folks, since we've got so many on the call. So the last thing I wanted to talk about is I went back and forth how I wanted to name this webinar, but I had to think about like the people I send it out to, because I send it out to also all our tax accountants, all y'all's tax accountants, just to say, hey, if you've got clients that would really benefit from this webinar, pass this to them. And so one of the titles I wanted it to be, and really kind of the feel of this webinar I want, is everything you want to know about the balance sheet but are too scared to ask your CPA, right? Or maybe you ask them and they give you an answer and you just are like blank stare, like, I have no idea what you just said. They're just talking in a totally different language. So we want to break it down in layman's terms, in business owner terms. We know that the majority of you, the vast majority of you are, we're not in business school, we're not accounting majors. So that's important to us, is how can we show you the value of looking at this report in a way that makes sense to you. So we want to definitely make sure we've got time at the end for questions, but we are going to try and get through this. You can send questions to the chat, but we won't start addressing them until the end. Okay, so with that, we're going to have Erin take us start off the journey.
Yeah, let's talk about what a balance sheet is. So your balance sheet is one of the basic financial statements. And Katie argues all the time, it is the most important financial statement. It really gives you a snapshot of your company's financial position. And it's that snapshot at a specific point in time. So have y'all used a Polaroid camera? I think they're back in right now because my kids got one for Christmas. So you can actually use the new Polaroid film and take that snapshot. So your balance sheet gives you a snapshot of your financial position at a point in time, like that Polaroid picture. And it's going to show you what your company owns and what is actually owed by the company. And we break it out between assets, and assets are equal to liabilities plus equity. So if you took any accounting class ever, hopefully that's the one thing you took away from it, is that accounting equation. On your balance sheet, your assets equal your liabilities plus your equity. And for our not-for-profit friends, that balance sheet, as Katie mentioned, is called your statement of financial position. And so on your statement of financial position, you'll still have assets and liabilities. Your equity section is just a little different. We call your equity section your net assets. And you break out your net assets sometimes between if you've got restricted net assets or unrestricted net assets. And really the difference there is really if there's donor imposed restrictions on how you're using those assets. So that's an overview of the basic financial statements. Let's break out what are assets. So assets are really what the company owns, and we're looking at the resources of the company. So it's what your customer owes, it's your inventory, it includes your fixed assets, your property, your plant and equipment, any vehicles. So those are your assets, what the company owns. Your liabilities are what the company owes. So think about those financial obligations of the company. So it's going to include your accounts payable or what you owe to your vendors, the vendors that you're buying from. It includes your payroll taxes if you're not paying them immediately. It includes any sales taxes that have been accrued but not yet remitted. And then it also includes longer payables like loans or debt. And then you've got your equity section. So your equity section is what your owners are going to invest in the company. So it generally includes your retained earnings and any contributed capital. And again, for those not-for-profit friends, the equity section is your net asset section, and that's going to be really just your assets minus your liabilities. And it's broken up between your restricted net assets and your unrestricted net assets. All right, so an in-depth look at your assets. You can break out your assets between current assets or your short-term assets. So how quickly you can turn assets into cash. Those are going to be your current assets. And your longer-term assets. Your current assets are going to include your cash and your cash equivalents, any marketable securities, what your customers owe you or your accounts receivable balances, any inventory items, those goods that are ready for sale, and prepaid expenses. So if you prepay your insurance, that's going to be a current asset because generally you're going to use that up pretty quickly. Then you can look at your long-term assets. Your long-term assets are going to be your longer-term investments, so stocks, bonds, those things you are going to hold for longer than a year. And then your fixed assets, so land, vehicles, equipment, buildings, that makes up your long-term assets. Okay. Now looking at liabilities, we break out liabilities between current liabilities and long-term liabilities. And your current liabilities are your short-term debt, or generally debt that's due in less than a year, and any short-term payables. So what you owe your vendors, accounts payable, any interest you owe within a year, those payroll taxes that are due. Your longer-term liabilities are going to be your long-term debts. If you've got a mortgage debt, if you've got a commercial loan, a vehicle loan that it's longer than a year, that's going to be in your long-term liability category. And then if you've got any of those deferred taxes that are due longer than a year, you're going to classify them as long-term as well. And then finally, looking at the equity section, your equity section is going to include your retained earnings. And your retained earnings are those profit and losses that have built up by the business year after year. Hopefully it's the profits, right? You want the profits to build up in your retained earnings. It's going to include any member draws or any member contributions. So what's been taken out of the business throughout the history of the business or put into the business. And then it's going to include that current year net income that when you close the year, it's going to roll into retained earnings. But when you're looking at it during the current year, you'll see that net income line. And again, as we mentioned earlier, on the statement of financial position for not-for-profits, you're going to see this as your net assets. Same meaning, just different terms for your not-for-profits. All right. And I'll let Katie take us through how the balance sheet tells the story of your business.
Okay, so I stole this from Andrew Gay, who is the owner of Grimsley and Company. He's my tax accountant, and I know that his firm does the taxes for over 20 of our Lilyfield clients. So some of you know exactly who I'm talking about. But he always says the balance sheet tells the story of your business. And I love that because it does. I can look at any balance sheet and I can tell you, one, if you're in good financial shape. Two, it can tell if you're struggling. And I can also tell if you've just got a total mess on your hand. So when I get sales leads that come in, I always see if I can look at their balance sheet, and then I can immediately know how much time and effort is going to need to go into cleaning the books up if it's a client that's come to us in crisis. So the first thing you want to do is you look at the asset section to see how much of the stuff do they own? Do they have a great cash balance? You know, is their AR totally out of whack? You know, how liquid are they? Could they pay their debts tomorrow if everything's shut down? And then you look at the liabilities to see, how much is short-term liabilities, the payroll liabilities, sales tax, payables, the things that have a monthly turnover. What does that look like compared to the long-term debt? Because the long-term debt, may be stretched over 5, 10, 20 years. And then you just look at that equity section, and that's going to tell you, did they make money? How much are they pulling out of the company? So there are all these different things you can see. And finally, the last thing is you want to be able to compare the balance sheet with previous periods. And how this is valuable is that you can identify trends and changes in your financial position. So one of the favorite ones I use when I'm looking at Lilyfield's balance sheet is I'll look at last month and the previous month and then the previous year. So a year ago. So I'll look at how did my balance sheet change from this year to, or this month to last month, and how has it changed from this time this year versus this time last year. And then you ask why, right? Then you need to be able to, as a business owner, say, okay, why did my cash go down or why did my cash go up? So it's really just, asking yourself, okay, I'm looking at this balance sheet compared to previous periods, and can I explain or tell a story about why it's changed? Now, I did make a note for my Lilyfield clients. If you are just getting a standard balance sheet, the standard balance sheet is the first set of reports we sent out to our clients so they don't get overwhelmed. If you are receiving a balance sheet and you want the type of balance sheet that is showing current month, prior year, just shoot an email over to either Aaron or the manager on the job that's sending you those monthly reports and just say, hey, I want the balance sheet that Katie talked about in the webinar. Both managers are on this call right now, so they'll be fully aware that that's a new balance sheet that you're wanting to look at. I think you'll find that really helpful if you, after this webinar, want to continue to review that balance sheet on a monthly basis. So the next slide is, why is the balance sheet the most important report? So why do I get up on my pedestal and I'm like, the balance sheet is the most important report? Okay, so I'm not going to bore you with accounting. Obviously, you guys did not, become accounting majors, which is good, keeps us in business. So the technical detail, the technical reason is based on debits and credits. You may have heard of debits and credits. If your balance sheet isn't correct, your profit and loss is not correct. So if you're one of those people at the end of the month that runs and pulls that P&L to see if you've made money, but you're not also looking at that balance sheet to make sure there's nothing wonky, you're looking at a potentially inaccurate P&L. So what we do at Lilyfield is we do a mini audit every month on the balance sheet. So that way we know when we send you your financials that profit and loss number is going to be correct. So what we do is basically tie each item out on the balance sheet. Does cash tied to the bank statement? Does accounts receivable tied to your AR aging? So we go through each one, and each line of the balance sheet has to tie to something. And if an outside source, something out of QuickBooks. That's why we're always asking for your bank statements, your credit card statements, your loan statements. We've got to tie these numbers out to an outside source. And then we've got confidence that net asset, or that the net profit number on the P&L is correct. So when you're looking at a balance sheet, the main reason I want to look at it is it will alert you to any problems in your financial reporting. And we're gonna go through some examples together so that we've got a good balance sheet, and then we got some not so good balance sheets we want to look at together so you guys can see what we're talking about. But for my non-Lilyfield clients, if you've got somebody else doing your balance sheet in your office, or you are trying to do the balance sheet yourself, it's we'll show you how to see if there's problems, like what should you be looking for. And then you can then after that look at, say, hey, so-and-so that's doing my balance sheet, this is weird. Why does it look that way? So that leads me, I'm like just flowing naturally into the next bullet. So this again will let you know if your bookkeeper knows what they are doing. So again, at Lilyfield, what we do is we've got your boots on the ground bookkeeper that's doing the books all week or all month. And then at the end of the month, she reconciles everything, shoots it over to the manager. The manager reviews that balance sheet. So you should not ever have an inaccurate balance sheet heading your way. But if you don't have somebody, if you are not outsourcing your bookkeeping, you want to make sure you're reviewing this report on a monthly basis so that you can be alerted to any issues that might be popping up. And then the last reason it's one of the most important is for all my folks out there that are S corporations, partnerships, or nonprofits. A balance sheet is a required schedule on your tax return. So if you send, your balance sheet over to your tax, if you're one of these types of entities and you send that over to your tax accountant and it's wrong, they're going to have to spend time and money trying to get it correct so that they can then, do the tax return. So they're not just doing the tax return, they're cleaning up your balance sheet and then doing the tax return, which is just going to cost you more money in the long run. Okay, so we're going to take a look at some real life balance sheets. And what I'm going to do is we're going to try and make it a little fun as balance sheets can be. We're going to talk about the technical aspects of it. Like I'm going to point out what makes it a good or a bad balance sheet. And then I'm going to talk about the story, right? The story that I have in my head of that particular company. So we're going to start off with the good, stay positive. And we are going to look at this particular balance sheet. What makes this one good? So from a technical standpoint, everything is going in the right direction. So the only things that are a negative balance are things that should be a negative balance. For instance, the less accumulated depreciation is a negative, and that is correct. And down below where there's an owner's draw, that is a negative, and that is correct. Everything else is going in the right direction. You would want to be concerned if cash was a negative 123, right? Or your notes payable down below was a negative 86,307. Those aren't going in the right direction. So this is a good balance sheet because everything is going in the right direction. One other, everything is appropriately classed out between current assets and long-term assets. So you can clearly see that your current assets of 173,000 could easily cover your current liabilities of 52,089. So this particular company is not going to get into a cash flow issue. So now I'm kind of like morphing into the story, right? So they're in a very good financial position. They've got a strong cash balance and receivables. So they are very liquid and they can easily cover those current liabilities and the long-term liabilities. If they had to shut down tomorrow, they would be able to pay all their debts right then and still have money left over. So that's what tells me that this company is in a strong financial position. Also, at the very bottom where it says net income or loss, they've made 35,000 just in the month. So, because it's the month of January on that balance sheet. So I was like, you go. So, so that is like the story of this particular company. Very strong cash position, not a whole lot of debt. So that's a thumbs up one. So now we're going to go to the next one. All right. So this is what we call the bad. And if we were in class, I'd have you do a show of hands. Why is this one bad? So the reason this one is not great is it's too condensed. It's not giving us enough information. So it's just lumping everything into current assets and fixed assets with no detail of what those are. That current assets of 9,000 could be $50 in checking and the rest is in prepaid insurance, like, so it's not letting us get a clear picture of what's going on. And then the liabilities are all lumped together in just one line. Is that a $30,000 truck and $1,000 in payroll liabilities? Or is that your American Express bill that's due next month? And you clearly don't have the current assets to cover that Amex bill. So just not enough detail to really tell the story of this company. But again, the fact that the liabilities are greater than the total assets, not a great financial position you want to be in. And the other piece of the story is that I can tell that they may have a bookkeeper that doesn't know what they're doing. So that would be the story that I would come from here. And so, if this client came to us and, wanted us to clean up their books, the very first thing we would do is start to aggregate those into more of the broad topics. Now we are, so that is two aggregated. Not the next one, but the one after that is going to be where you're sharing too much, but we'll get there in just a second. Okay. All right, let's go to this one we called the ugly. So we have the good, the bad, the ugly. This is the ugly. So, gonna see if you guys can tell. So we play a game we do an annual beach retreat at Lilyfield, and we play a game where I give financials like this to the team, and they get 1 minute or 5 minutes with a highlighter to go through, and they've got to highlight everything that's wrong with that particular financial statement. So I thought it might be fun for you guys to do that too. So from a technical standpoint, you've got accounts receivable going in the wrong direction, which, unless there's a reason for that, you really shouldn't be going in the wrong direction. And the next one that drives me, this is my personal pet peeve. I'll let every new employee at Lilyfield do it one time, and then they hear from me and they don't ever do it again. Uncategorized asset. Nothing should ever go to uncategorized asset, ever, 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 ever. So what is it? Like, what? Uncategorized asset. So sometimes in QuickBooks, so for my folks that aren't Lilyfield clients, sometimes in QuickBooks, if you are coding the bank feed and you're just going through and it doesn't know where to put something, that's exactly where it's going to go. It's going to go to uncategorized asset. Let's look. Business credit cards, sales tax payable. Okay, sales tax payable is going the wrong direction. Should be a positive liability that you pay off. This tells me, did they overpay sales tax? Like, what's going on here? The next one's a payroll liability. So the first thing I would do here, why is your payroll liability over $34,000? And this actually happened to a client that we took on. And I saw that their payroll liabilities was, I think it was in the 40s. And that alerted us to the fact that the prior bookkeeper had never remitted the Florida reemployment tax and the 941 tax for, I think it was six months. So that is a huge red flag. You can get a lot of trouble for not remitting your payroll taxes. So that's a technical one there. And if we come down, we have the owner's draw, and the net income and loss. So now I've gotten through most of the technical stuff. Let's talk about the story of this business. Okay, so we've got total assets are negative. So not a great cash position, right? There's only $1,000 there to cover the liabilities of $59,000. And we don't even know if our accounts receivable, we clearly can tell it's not right. So even if we were going to get on the phone and start calling people to pay us, we're still not going to have enough to necessarily pay those credit cards down or pay off this payroll liability, right? Which can get you in a lot of trouble. So we can tell the story of this company is in crisis. The other piece that's interesting to me is that the owner draw is $65,000, right? So I would be like, owner, what's up with the $65,000 draw and you haven't remitted payroll taxes, payroll liabilities? right? Where's that cash going? That's not good. In fact, that would be a red flag. I wouldn't even take them as a client. So, okay. So the last one is the oversharing balance sheet. All right. This is, we call it over bookkeeping, oversharing. You have to remember that a lot of times the balance sheet is a report that you send over to a bank or a lender, or somebody that's interested in your company, and they don't need to know all this information, right? So the things I highlighted here is under accounts receivable. You don't need to list every client under accounts receivable. Okay, we've got the accounts receivable number ties out to an aging report. So we have another report that's going to tell you what makes up that 50,000. So you don't need to be putting the clients on there. Plus, if you're using the client names, not good. Nobody needs to know who your clients are. Fixed assets. Let's take that Suburban, the Cadillac, and the Lexus. Let's lump those all together and just call them vehicles. All right. The bank doesn't need to know what kind of car you're driving. So that's one. I see that a lot where people, instead of using broad fixed asset categories, they'll list they'll book it to the actual asset that they purchase. Again, if we've got vehicles, you can click on vehicles and then see all the detail. Then you can see the Suburban, the Cadillac, the Lexus. That's good internally, but for a purpose of a balance sheet that you might be sending to a bank, they don't need to know what kind of cars you're driving, right? Let's see what else. Oh, then we get into the loans from a family member, loans from a friend, Suburban loan, Lexus loan. Let's make these much more generic. We can just have loan payable, note payable, vehicle loan 2538, like capital city loan, something like that. That's not necessarily telling who's ever reading this too much information. So this one is another one that if I saw this, I would know they probably didn't have a strong bookkeeper doing their books, or maybe an owner was trying to do it themselves and just couldn't figure it out. But this is the oversharing over bookkeeping balance sheet. So going to try and strike a balance there. So that's enough on actual real live stuff. I'm gonna kick it over to Erin really quick just to let you know about the free gift that we're sending your way. And while she's doing that, I will look at the chat board for questions if we've got time at the end. We want to respect your time. You're busting this out at lunchtime. We appreciate it. So we'll try to get as many questions as we can.
Yeah, so continuing on with Katie's story on how you know if you have a good balance sheet, she talked about current ratio while she was going through. And so your financial statements, your balance sheet numbers, and you can calculate your own current ratio. And then you'll figure out if you've got a good story to tell. You want a current ratio that's greater than 1. You can look at working capital. So how much money's left after you pay your short-term debts. So your working capital, you're going to calculate by your current assets minus your current liabilities. And here we want this number to be a positive number. If you've got a negative number, it means you probably got some liquidity issues. And then you can also calculate your days cash on hand. And this is going to tell you how many days that your company can cover its operating expenses. And you want to calculate that by taking your liquid cash, your cash plus your marketable securities, and dividing it by an average daily operating expense. So take your operating expenses, take out any non-cash expenses. So if you've got depreciation on your profit and loss statement, take that out, back that out, and then divide it by 365. And that'll give you your days cash on hand. Here, a higher number is going to tell you that your company has a better chance of withstanding any potential unexpected financial challenges. And then you can look at solvency ratio. So here, the solvency ratio we're looking at, there's a number of them, but we're looking at net income divided by total liabilities. And this is going to tell you if you have enough cash flow to pay off your long-term debts. Okay, so that's a few ratios that you'll get a Excel worksheet after the webinar so you can plug in your numbers and go through these yourself. But a word of caution, remember it is a story you're telling. So you can't just look at one of these ratios by themselves and think you have enough information to make a decision. You don't, you just don't. You need to look at it in total with respect to your current situation. And you also need to look at more than just one ratio because you can't see the big picture. So looking at the solvency ratio, there's a limitation in that. It doesn't necessarily factor in that you could go out and acquire new funding, right? And that could help support your what you need to pay off in your current situation as well. So you got to look at it in total, but these are just some ways you can break down the balance sheet and look at your financial position.
Yep. And like Erin said, we'll be shooting that off to you guys after the webinar with a brief survey just to get feedback from you guys so we can keep improving these. I do have one question so far, but I'll keep checking back. Someone asked, would you always start with the balance sheet? Yes. And we always put the balance sheet first in your reporting package. If you're a Lilyfield client, it's always the first one. Just do a quick look through, make sure nothing looks wonky, and then move on. Then you just have the confidence to move on to the profit and loss and know that that one's going to be accurate. Is there a way to include current market value of your assets on the balance sheet? Erin, do you want to answer that one? Is there a way to include current market value of your assets on the balance sheet? I feel like that would only be if you had investments.
Correct. So
Yeah.
if you have investments and you're following GAAP accounting, so a lot of our Lilyfield clients are just on the tax basis, so cash accounting basis. So generally we're following, if you've got an investment, we're including that investment at fair market value because that's the cash value of that pulled from statements.
Right. And then I've got another one that says, is there an easy way to see owner's basis in the balance sheet, or is that more involved? And my first reaction is that your owner basis is related to an S corporation or a partnership, and that's really kind of calculated on the tax return, not so much necessarily on the balance sheet. Would you agree, Erin?
Yes, but to get just a generic snapshot of it, look at your equity section.
Right. And then let's see.
The difference between retained earnings and net income. So when you're looking at the equity section and you see retained earnings, your retained earnings is going to be what has come in as income from the history of the company. So since inception, that's going to be the net income that rolls every year. The net income section under equity is the current year net income. And so when you close the books for that fiscal year, it'll roll into retained earnings and start fresh from the next year.
Okay, we've got one other question that's not balance sheet related, but you guys may be interested in hearing the answer to it. It says, what would you say is the difference between a bookkeeper, an accountant, and a CPA? The best analogy I use for this is a nurse practitioner, a physician's assistant, and a doctor. So your CPA has gone to school, done 150 hours, passed the CPA exam. And normally you would use them if you had complicated taxes. If you're an S corp, if you're a partnership, if you've got lots of different things going on and you need that tax planning advice, that you would want to have a CPA, and we would direct you towards one. Now, if you had a more simple type return, for instance, my husband's a W-2 employee and I have Lilyfield, it's relatively easy. I could easily go on to TurboTax and do my own taxes. There are enrolled agents that are actually have gone through classes with the IRS that can do your tax returns. So there's different options. You don't necessarily need to go full-blown CPA, but I personally use a CPA, and that's because of the tax planning piece of it. Is I just don't want to be surprised at the end of the year. Surprise, you owe $1 million in taxes. So that's why I personally choose to use one. Now, an accountant, a bookkeeper, and an accountant, sometimes those words are interchangeable. Usually accountant means that they have gotten a degree in accounting. is that's kind of how we do the term. And then the bookkeeper, we always call our bookkeepers the boots on the ground. So they're the folks that are actually putting transactions in. They understand, money comes in, money goes out. They may not know all the particular laws. Maybe new laws are coming out, or accrual accounting entries, which again is why at Lilyfield we have a manager review the bookkeeper's work. But the bookkeeper is the one that's in the nitty gritty, sending you the ask my client report. What is this $47 charge to Target? Did you use the wrong credit card, or is this a legit expense? And just, that's when you're developing your relationship with. I always joke with Andrew Gay, who's my tax accountant. He sends me clients, and I tell him sometimes I tell him, hey, you only have to see this person once a year for the tax return, and I have to deal with them. My team's dealing with them on a weekly basis, so we need to make sure we're getting quality folks here. So hopefully that answered your question. If you've just got a little cough, you don't need to necessarily go see a heart surgeon for it, right? So you just want to make sure you're pairing the complexity of the work with the right area of expertise on that. And one other, let me see if there's any other questions that came in while I was doing that. Okay, no, I just want to do a shout out to my daughter, Autumn, who is on this webinar. She's a freshman in college and taking her first financial accounting class. Autumn, glad you're here. All right. Thank you guys so much. We recorded this, so we'll be putting it up on our YouTube channel for anyone else that you think may benefit from this. And we will see you guys in a couple months. I think our next one is in April, and that one will be called Keep Your Personal Out of It, right? Why we don't want to be commingling and putting personal stuff in our business, and why that's important. So hope to see you guys there.